Hi everyone. In today's video, I'd like to explain the concept of order blocks, something that's very highly used in ICT and smart money concept trading communities. I'll explain what I know about order blocks and how you can use it to your advantage. So to begin with, I'd like to explain three main types of blocks. So the first type is called rejection block. Rejection block is essentially a candle that sweeps a major point of liquidity but doesn't close with its body above that point of liquidity that has been swept. So let me just show you an example of this price action. So we're going up, then we go down, then we retest this high, but we sweep this high's liquidity and then go lower from there. And the rejection block would look something like this. So we have a candle that sweeps the liquidity with its wick, but doesn't close with the candle's body over this high. Yeah. So, and most importantly, we want this high to be a fractal liquidity. So fractal liquidity, for those who don't know, it's either a 3 or 5 candle formation where the highest candle is higher than 2 candles on the left and 2 candles on the right. So let me just quickly show you on a 4-hour time frame how it would look like. It's mainly used on a high time frame from 1 to 4 hour, 1 day and weekly. And as I already said, it helps to identify major points of liquidity. So all these dots are fractals. So as I said, 2 candles on the higher than 2 candles on the left and 2 candles on the right, sorry, low in this case. And a good example of rejection block would be this. So this candle sweeps liquidity of this fractal. It doesn't close with the body below this candle, it leaves a wick, and then we do a break of structure, come back, test the 50% of this rejection block, and then go higher. So going back to the rejection block explanation, what I was explaining earlier is the way to mark rejection block is we only mark the wick. Okay, so this would be our rejection block. And now what we want to see is either a test of the 50% of this rejection block and go lower, or another example, a sweep of rejection block. And after that, we want to see a move downwards. Okay, so that's the first one. The second one, which is the main point of this video, is called order block. Order block is formed at the sweeps of liquidity. So imagine we have downward trend, then we're changing higher, we start going up. Order blocks will be formed at every sweep of liquidity that happened, as long as there's FVG formed between the next candle and the candle after that. So for example, we have this, and then next candle, 2 more candles here. Yeah, let me just draw the wicks as well. So let's say we have a wick here, wick here. So an order block will be formed when there's an FVG between the next candle and the candle after. So this will be our FVG. And as long as there's an FVG, this will be a valid order block. And we mark both the wick and the body. So if there was a wick here, we'd also mark it as an order block. Just like that. So that would be our order block. Okay, and how we want to react with how do we want to use order blocks is basically if price were to go lower, we want to see the test and then a move downwards. Okay, so in this case, if we're looking at the bullish price action on the left, order block could be here because of swept liquidity. Order block could be here. Oops. Order block could be here as well, and all these lows that have been formed. Okay, one important assumption is we want order blocks not to be tested when price comes back to it. So if the price has already tapped this order block, we do not want to use that in the future. So we only use the order blocks that have not been tested, have not been tapped before. Okay, and the third one is, I can't go any further. The third one is breaker block. Breaker block is essentially a failed order block that has been disrespected, but then price comes back to it later. So let me just explain what I mean. So in this case, we may have an order block here, but because the price disrespected it and penetrated it with its body, went lower, now we have a break of structure and we want to see bearish setups. But now we leave this order block extended to the right and wait for price to come back to it and show us some reaction so we could short. Okay, this is essentially a breaker block. So as long as you know what an order block is, you should be able to understand what a breaker block is too. Another important thing that I'd like to mention is the use of inside candles. This is an indicator that you can enable in your trading view. Personally, I have it here, but I have a unique spine script formed for that. But I think the usual trading view should work just as fine. Why do we use inside candles? So maybe you can see on my chart, I'll show you. Why do we use inside candles? So on my chart, I made them as white candles, yeah? And essentially why we don't care about them is you may have seen influencers on YouTube saying that if you're doing a high time frame analysis, you will see that the candles that are still within the range of the previous candle, it's like a low probability condition. So for example, in this scenario, we have a candle and for the next 6 days, its low and high has not been swept. So it's usually regarded as a low probability condition because it's just accumulation, and soon enough there will be a sweep on either sides and your stop can be manipulated very easily if you're not being careful. So we do not care about anything that's happening within these candles. Obviously this is daily time frame, but this applies to all the time frames: 1 minute, 5 minutes, 15 minutes, 4 hour. So that's why we do not pay attention to them, because it's just accumulation of price. So what we want to see is, so imagine that this is a candle. We want to see price sweeping one of the sides of this candle, but before that, anything that happens within it, we do not care. So as long as the candle's high or low has been swept by at least 1 pip is enough. We know that the liquidity has been swept, and now there's a potential for either reversal or a continuation of the price. Okay, so now we do not expect any further consolidation, and that's why we use inside candles for a more precise moves and high probability condition setups. Okay, so let me just show you an example I've seen this week. So for example, we have a low that's been formed, yeah, and then we have inside candles after that. We do not pay attention to them at all. We only care about this candle because this has broken the high of this bearish candle, and now we mark this as an order block because there's an FUG between this candle and this candle. So essentially this is going to be the FUG. Okay, this is how you should mark it, because all of these candles are consolidation. We do not care about them, and this just shows you that this order block actually works. So price comes back to it, goes higher. Okay, this is just a good addition to your trading chart. Inside candles are very useful. I've backtested them for a long time, and I can confidently tell them they work. This is just basically something that I use, and you don't have to do that, but it's just what I do. And then we're going to go next to explaining how the range works. So I'm going to do it very quickly. So for example, we were bearish, and then price reverses, does a break of structure. We're bullish now. When do you identify the new range? Where is this low? Where is this high? How do you know where you should entertain this range? So there's something called inducement. Inducement is the recent low that has made the new high. Okay, so this is our inducement. And as soon as the price comes back to this inducement, our range has been formed. So now this is our low, and this is our high. Oops. Let's put it like that. This is our high. So now that we have a range, I usually mark 3 order blocks within this range, 3 main order blocks. Okay, so the first order block will be the first order block from the IDM, the closest one. And a very important assumption is that all these order blocks, they have to not be tested by price prior to that. So let me explain what I mean by that. So if this is an order block that's not tested, that's fine. We mark it, we wait for reaction of the price to come back and then go higher. But if this order block has been tested prior to this, like that, we do not count it as a valid order block because it has no use for us, okay? Maybe the sweep of it could be useful, but if the price comes back to it, you would normally not wait for any setups because it's just not high probability setup. You want to see a gap and you don't want this block to be tested. And first order block is very, very important because if a price is very bullish and we have really nice bullish price action, price would normally not go back to OTE. It will just tap the order block and then go higher from there. So this may be the case when you have seen that you were anticipating a retracement into the OT area or a bit lower, and price just does a small retracement and goes higher. This could have been the reason that the first order block has been tapped and price continues its bullish movement. The second order block would be the order block in the OT area. This is a very obvious one. I mean, obviously, if you just draw an OT, you would expect price to come back into OT and go higher from there. So not much explanation here. But the most important one that I like personally the most is the external order block. External order block is formed at the lowest point of the range where there has been formed an untested block. So again, if this block has been tapped already, we do not count it. We would just use this block instead, okay? So it'd be like that. Why do we care about external order block so much? The reason for that is it is the last support, or maybe let's say the last liquidity area for the price to touch before breaking the range. So usually you will see that price comes to this block, forms like a reverse span, break of structure, and go up from here. This is very, very common, and this is like the sweetest spot to catch longs, okay? So from here you can catch really good RR. Now that I've shown you how to identify a range and which three main types of block I use, I'm going to show you how you would apply it to charts. So let's go back to the previous example. So here we have IDM, yeah. That's going to be our IDM. Price goes down. This is going to be our first block. Oops, here. Our first block. Price comes back into it nicely, renews the high, comes back to this external order block, okay? And then from here, we have a new range. So now from high to low, we have again IDM. And now, what do we mark? We mark the first block closest to the IDM. So we look for order block here, and it's going to be over here. This is our first order block. And you can see how nicely it's being respected. From there, again, we mark a new structure. So this is our IDM. Our first block has been tapped, failed to renew the high. So now we come down, we wait for the price to tap the external order block. So this is a valid order block because it has not been tapped. So as you can see, there's like 2 pips gap between these blocks. Price comes back to it and goes higher from here. Okay, and then there's just many examples like that. For example, in this range. So this is going to be our IDM. No, actually, this is IDM because if we were to draw the structure of this move, it would be something like that. So what is the high that made this low? Oops, it's going to be this high. Okay, so that's going to be the high, and we're going to draw IDM from here. And to mark the first block, this is going to be this. So IDM, there's no block in here, no block in here. This is the first block. We got a small reaction, and from here you could catch some really good shorts. So for example, if you drop a 1 minute time frame, you would see the reaction. We broke the low, and then now you apply the same thing that we did. So again, you draw the range, you look for blocks within this range. So all these range rules and blocks, they apply to all the time frames, 1 minute, 15 minutes, like absolutely all time frames. This is why everyone says, and ICT himself say time is fractal, because here, for example, again, this is our IDM. Oops, why is my drawing so bad today? This is our IDM. Now we wait for blocks. So where is our first block within this range? This is not valid because it's already been tapped. No, there is no block in here. This is going to be our first block. We have no reaction of that. So let me just draw it for you to understand it. So first block, we get no reaction of that. But then we have the external order block. This is the last block because this is not valid block. This is not valid block because it's already been tapped. And this is an external order block, and see how price just doesn't sweep on 1 minute. But if you were to drop on 3 or 5 minutes, you would see that this nice pin bar. And if you were to cut shorts just of this candle pattern, you could have caught some really good shorts. Oops. This is something how I would really enter. But because it's before the New York session, I wouldn't really want to entertain it just because of the kick of liquidity. But this is something I trade. This is A+ setup for me. Okay. And what I wanted to touch on last thing finally is that within 15-minute blocks, you can find 1 minute order block. And that's like A+ setup. That's like the best setup you can find because that gives you such a precision that you wait for that 1 minute block and you entertain exactly what you wanted. So, and the same applies to 1 hour order block where you find 5-minute order block within it. And the 4-hour order block, you want to find 15-minute order block within it. So let me just explain to you what I mean by showing you a good example. So this was a very good example that I've seen on the 11th of April. And we have this range again. So IDM, high, low. This is our external order block. And at the first time, price doesn't really interact with it. You're just consolidating, not doing anything. So we just wait. I was just trading shorts within this range, so which is fine. But if you were just to focus on this order block, you can see the price comes back to and goes higher. But what if we zoom in and look at 1-minute order block? So if we zoom in, okay, let's scroll to the left. Let's find another block within this. Let's see if there is one. It doesn't always happen, but if there is one, it's very high probability trade. So this is a transition rule, by the way, I forgot to mention. So whenever there is no gap between this candle and the next candle, you can like transition your order block to the next candle, and it works really well. I'm just going to show you in this example. It's kind of perfect one. So you transition it to the next candle. See, this is going to be our order block. So if we mark it like that, zoom out, extend it all the way to the right. Yep. Like that. Okay, so you see how price came to this block, even though this happened like 4 days earlier. Like, it doesn't really matter, because what price has printed a week ago, a month ago, will still be valid like in the future, because even though it was a 1-minute block, it's still valid, guys. Like, money doesn't do anything for no reason. There's this algorithm, and it works perfectly. So I'm just showing you this example right now. So we tap the 1-minute order block, and can we do it faster now? And it just goes up from here, right? You could have caught really nice long here, because we sweep IDM, not IDM, this liquidity, and go higher from here. Okay, backtest it yourself, see if you can find any use in it. This is personally what I use. I'm not recommending you do anything about it. It's not financial advice again, but I found it really, really useful, and it helps me a lot. I can also touch on the importance of order blocks versus FEGs, right? Why do I not use FEGs, and why do I use blocks instead? It's very simple. The main reason is it provides precision. Order blocks provide the best entries, in my opinion. So for example here, yeah, you have this FEG, like this FEG here. I know it's been tapped already, but let's say this candle didn't tap. You have price tapping it so many times, and it never really breaks the low. How do you know that this is actually gonna break down from here? There's also times when there's like 2 or 3 order blocks, FEGs in a row, but in this context, you can see that price taps order block, sweeps it, resweeps again, and dies from here. So only when the price tapped order block, that's when the real move started, not the FEG. You can use FEGs on higher time frame to use as a drawn liquidity, but on lower time frames, I don't think that's something I use. It just doesn't provide enough precision. Or for example, in this case, look, we have this FEG, we have this FEG, we have also this FEG. How do you know where it's going to react off? So because it tapped all of them. But if you were to wait just for price to provide you confirmation 1 hour time frame, you will see that we swept this order block, and from here you wait for a boss on 15-minute, wait for a retracement, which is probably this. I don't want to drop down, and it will go higher from here. Okay, I think just order blocks are way more useful way to enter the setups, and it provides more credible sort of confidence. Okay, for example here as well, like I know it hasn't tapped the order block, but you have 1 FEG, 2 FEGs, 3 FEGs, 4 FEGs. Which one are you going to enter off? Because you can easily get stopped. Like you would have seen the reaction on lower time from here. You probably tried longer, you would have been stopped. Or even here, like for example, FEG, no reaction given, literally no reaction given. But if you were to wait of the reaction of the order block, which was represented in the form of a sweep, you could have caught some good shorts here. Okay, so it's just all about precision. The 1% of traders is the best for a reason, because they wait for exactly the confidence that they need. They don't react of every PDA out there. They only wait for the best probabilities, so that they have the highest chance of the ATP being hit. And even in this case, for example, look, very good example. We have FVG, FVG, FVG. Which one do you use to short? Like, you don't know for sure, right? But because you have one order block, we tap the order block, sweep it once, twice. The resweeps are crazy. Like, this is the best probably confluence you can use. So if the fractal is swept, another fractal is swept, on the third sweep, it's most likely gonna die. So within this order block, we had two sweeps, and we just died. So see how price was waiting for this order block to come lower and not these 3 FVGs, okay? That's it on this video. I hope you found it useful. I try to explain as good as I can, but because my speaking skills aren't the best, I'm still learning. I hope you understood everything very good. If you have any questions, don't hesitate to comment in this video. I'll try to answer all of your questions. And also feel free to subscribe to my Telegram channel where I post my trades, and I can communicate with you there, which is much easier and much faster way. So I hope you enjoyed this video. Thank you.